There's $867 billion worth of unsold cars choking America's dealership lots right now. This massive pile of metal represents the ultimate consequence of pandemic-era greed finally catching up with automakers. Just last week, a viewer snagged a $66,000 pickup truck for $39,900, cutting the price nearly in half. Meanwhile, dealers across the country are drowning in $127,000 monthly interest bills just to keep their inventory from getting repossessed. The reversal is stunning. The same companies that squeezed customers dry during the chip shortage are now practically begging people to take their cars at massive losses. How did we go from bidding wars and 6-month waiting lists to desperate fire sales and factory shutdowns? The story starts with corporate greed and ends with long overdue revenge for consumers. Back in 2021, the rules changed overnight. Dealers who once competed for your business suddenly flipped the script, turning empty lots into gold mines. Scarcity wasn't an unfortunate side effect of supply chain problems. It became the entire business model. New cars transformed into rare commodities, and sticker prices became meaningless. The real number was the market adjustment, which was just code for pure profit slapped on top of MSRP with zero room for negotiation. A $42,000 Toyota Tacoma suddenly listed at $59,000. Kia Tellurides carried $18,000 markups over sticker price. Dealers called it supply and demand economics, but customers knew it was highway robbery. Between 2020 and 2022, industry data revealed that 82% of new vehicles sold above their sticker prices. The average markup hit $4,048 by March 2022. Gone were the days of cashback deals, 0% financing, or year-end clearance events. Instead, buyers faced waiting lists, non-refundable deposits, and a take-it-or-leave-it attitude that would have been unthinkable just years earlier. One Ford dealership in California posted a $20,000 markup on an F-150 Lightning and told customers, "If you don't want it, someone else will." Automakers didn't just tolerate this behavior, they actively encouraged it. With production throttled by chip shortages, every car that rolled off the truck was a jackpot winner. The numbers from this period are jaw-dropping. Ford's gross profit margin skyrocketed to 9.85%, up from just 2.75% a year earlier. General Motors cleared $10 billion in net income while actually selling 13% fewer vehicles than the previous year. Stellantis reported $23.3 billion in adjusted operating income, crushing their own internal targets. The strategy was brilliantly simple and ruthlessly effective. Build fewer cars, charge drastically more, and watch the profits soar. Dealers played along enthusiastically because every car delivery became a lottery ticket. With supply artificially constrained, manufacturers prioritized their highest margin models, loaded trucks, luxury SUVs, anything that padded the bottom line aggressively. The average transaction price for a new vehicle shot past $47,000 for the first time in history. Incentive spending got slashed to nothing. Traditional discounts vanished completely. For the first time in decades, buyers routinely paid more than sticker price and received less value for their money. Earnings calls during this period sounded like victory celebrations. In February 2022, Ford CEO Jim Farley told investors, "We're not chasing volume anymore. We're chasing margins." Meanwhile, Stellantis CEO Carlos Tavares pocketed €23.5 million in total compensation as the company's cash reserves swelled to record levels. The profit party couldn't last forever, and the bill eventually came due. By late 2024, the average new car payment in America hit $745 monthly, a record jump from $575 just 4 years earlier. The average auto loan for a new vehicle now stretches to $42,113, while used car loans average $27,167. Interest rates deliver the killing blow to affordability. New car buyers with good credit face 6.7% APR, while used car loans hit 11.9% on average. Nearly 1 in 5 buyers now signs for payments exceeding $1,000 monthly. For families already stretched thin by rising rent, groceries, and insurance costs, the car payment has become the deal breaker. Most loan terms now stretch to 72 months, with some lenders pushing 84-month financing just to keep payments manageable. Even with these extended terms, the monthly burden remains out of reach for millions of Americans. Subprime borrowers with credit scores under 620 see offers at 15% or higher, with some used car loans reaching 21%, payday loan territory. The result is predictable. More shoppers are walking away entirely. New car loan applications dropped 7% year over year, according to Experian data. Dealers report plummeting foot traffic and online inquiries slowing to a trickle. Mike Rodriguez unlocks his Chevrolet dealership in Phoenix every morning at 6:45 a.m. and immediately checks the same devastating number: $127,000. That's his monthly interest bill just to keep hundreds of cars sitting unsold on his lot. This isn't payroll, advertising, or rent, just the cost of parking metal that nobody wants to buy. Mike used to carry 80 days of inventory when floor plan costs barely registered as an expense. Now he's stuck with 220 days worth of unsold vehicles, each one racking up $50 to $80 in daily holding costs. His floor plan bill alone hits $4,200 per day, even if not a single car leaves the lot. The math is brutal and relentless. The average new car sits 110 days before finding an owner, accumulating $5,500 in carrying costs on a $50,000 truck before anyone even test drives it. Mike's store holds 312 vehicles worth just under $14 million, with the interest clock ticking mercilessly on every single unit. Across the country, dealers watch their floor plan expenses explode from an average of $10,000 monthly in 2021 to $70,000 or more in 2022-2024. Some stores report $400,000 monthly bills just to keep inventory on their books. At 8% interest rates, a $10 million inventory costs $800,000 annually before selling a single vehicle. Satellite images reveal acres of brand new cars lined up in remote fields miles from any showroom. These aren't test vehicles or factory rejects. They're inventory overflow parked on rented gravel lots behind abandoned strip malls and shuttered fairgrounds. Dealers like Mike pay $6,000 monthly just to stash unsold inventory off-site, hoping buyers appear before the cars literally rot away. Every car in these hidden graveyards is a silent expense. Floor plan interest doesn't pause when vehicles leave the main lot. The meter keeps running at $50, $60, sometimes $80 daily per car, whether it's displayed prominently or hidden behind chain link fencing. Meanwhile, untouched cars become machines in decline. Batteries lose charge and die within 3 months. Tires develop flat spots after weeks in the same position. Paint fades under constant sun exposure. Weather seals crack. And fuel systems gum up from sitting idle. Service logs show 40% of new arrivals need jump starts before their first test drive. The bubble finally burst with devastating consequences. Factory lights went dark as assembly lines ground to a halt. Ford cut output by 35%, sending shockwaves through Michigan's industrial heartland. Stellantis laid off 15,000 workers in a single quarter, leaving families in Warren, Kokomo, and Toledo scrambling for answers. The layoffs created massive ripple effects throughout the supply chain. Tier 1 suppliers made similar cuts, while smaller machine shops, plastics manufacturers, and wire harness companies started closing permanently. In Michigan alone, more than 50,000 auto jobs disappeared within 6 months. Banks and lenders watched their exposure climb as dealer floor plan loans turned toxic. GM Financial reported $15.3 billion in commercial receivables tied up in North American dealer inventory, while Ally carried $14.7 billion on their books. When dealers default, banks get stuck holding metal worth less than the loans backing it. Now the numbers finally tilt in favor of buyers who waited years for a break. Chevrolet dealers stack rebates on Silverados and Tahoes, slashing $8,000 to $13,000 off sticker prices just to clear space. Ford F-150s move with $7,500 factory incentives plus dealer markdowns bringing some models under $40,000 for the first time since 2021. Electric vehicles became the ultimate discount bin. Chevrolet offered $12,500 off the Bolt EUV by stacking federal tax credits with factory cash. Ford Mach-E's sell for $9,000 below sticker with 0% APR financing. Even luxury EVs like the BMW i7 and Audi Q8 e-tron sit for months, accumulating bonus cash and desperate dealer markdowns. One subscriber played 3 Mercedes dealers against each other and landed a 2024 EQE for $14,000 under MSRP plus a free home charger installation. The $867 billion in unsold cars represents the direct result of years of profit-driven artificial scarcity and relentless overproduction. When unchecked corporate greed finally collided with real-world economic limits, the balance of power shifted dramatically. Consumers now hold genuine leverage for the first time in years, with discounts reaching 30% and unprecedented incentives reshaping the entire market. The evidence is overwhelming. The car companies that once squeezed every dime from desperate buyers are now the ones sweating over monthly payments, factory shutdowns, and inventory graveyards. For anyone willing to negotiate, the window is finally wide open.